This week, some of the hottest stocks in the market got crushed. Micron down more than 30% in a matter of weeks. SanDisk down over 30% too, after posting one of the best returns in market history. If you're seeing red on your screen right now, you might be tempted to panic and sell. But here's the question almost nobody is asking. Has anything about the actual business changed, or is this just the market doing what markets do? Welcome back to Wealth Signal, where we break down the numbers so you can think for yourself. Today, we're looking at 3 memory stocks getting hit hard right now, and why this pullback might be the opportunity, not the warning sign. Let's start with the scale of this drop. Micron has fallen more than 30% from its recent highs. SanDisk, one of the best-performing stocks in the entire market over the last year, is down roughly 30 to 35% in just the past month. SK Hynix, the company that actually invented the technology behind AI memory chips, has also pulled back sharply after a brand-new U.S. listing. So, did the story change? According to MarketBeat analyst Thomas Hughes, the answer is no. The demand for AI memory is still surging, and prices are still rising. What changed is investor behavior, not the business itself. After a run this big, some investors and insiders naturally take profits off the table. That is not a red flag. It is normal market mechanics playing out after a historic rally. This week's specific trigger was narrow. A South Korean investment firm lowered its sales target for SK Hynix's second quarter. But the reason had nothing to do with weakening demand. It was about fixed-price contracts, agreements that lock in a price and prevent SK Hynix from fully capturing today's surging HBM prices. That's a pricing structure issue, not a demand problem. Here's what matters. SK Hynix has already said it's moving away from those fixed-price contracts and has removed price caps on existing agreements. In other words, the exact concern that triggered this week's selling is already being addressed by the company itself. The underlying demand for high-bandwidth memory, the specialized chips that power AI training, remains extremely strong. SKF Hynix's own CEO has said HBM shortages could last through 2028. Some analysts believe it could stretch even longer, given how fast demand is accelerating. One recent forecast even suggested HBM prices could double next year. When the outlook for a product's pricing power looks like that, a short-term stock pullback tells you far more about sentiment than it does about the business. Think about it this way. SanDisk was up over 3,200% in the past year before this pullback. Micron and other names in the group posted triple and quadruple-digit gains too. When profits get that large, some investors sell simply to lock in gains, not because they've lost confidence. Insiders do this too. It's a normal, healthy part of how markets digest a historic rally. In market terms, this is what's called an overbought condition correcting itself. When too many buyers pile in, prices get pushed to a level where there's simply nobody left to buy, which opens the door to short sellers and profit takers. That selling brings the price back to a more attractive level, setting the stage for the next leg higher once fresh buyers step back in. Some worry this could turn into a slow bleed, similar to what's happened with certain software stocks lately. Analysts see this as fundamentally different. Software companies are AI users, benefiting indirectly from the boom. Micron, SanDisk, and SK Hynix are AI enablers, companies whose products are physically required to build the infrastructure itself, heading into an earnings season expected to reaffirm strong demand. Let's start with Micron, widely seen as the strongest opportunity of the 3. Micron is the second largest player in high-bandwidth memory behind SK Hynix, which controls roughly 60% of the market. But Micron is actively working to grow its share, expanding beyond NVIDIA into the broader group of AI infrastructure operators building their own chips. Micron is also investing heavily in capacity expansion, with new production capacity expected to come online next year. Interestingly, this pullback follows one of the company's strongest earnings reports, released at the end of June, which sent the stock to a new high before the slide began. That pattern is known as a sell the news event, where the rally happens on anticipation and profit-taking follows the confirmation. Despite the pullback, the underlying trend for Micron remains upward. The peaks and troughs on the chart have been progressively higher, which is the technical definition of an uptrend, and the fundamental story, rising HBM demand, expanding market share, new capacity, still supports that trend continuing once this bout of profit-taking runs its course. Next is SanDisk, a very different kind of memory story. Where Micron makes the volatile memory attached directly to GPUs for AI training, SanDisk makes the non-volatile storage that holds data permanently, even when the power goes off. That's the storage every AI data center needs alongside all that HBM to keep information intact. SanDisk used to be known mainly as a consumer flash drive company, a relatively unremarkable legacy business. It has since gone through what analysts describe as an existential shift, becoming a mission-critical piece of AI infrastructure. It's a transformation some compare to how Microsoft and Oracle reinvented themselves for the cloud era at just the right time. Even after this month's roughly 30 to 35% pullback, SanDisk is still up an extraordinary 3,200% over the past year. Wedbush recently raised its price target, saying it believes SanDisk's own management may be underestimating the strength of the business. SanDisk is expected to report earnings in the first week of August, and analysts expect another quarter of results beating expectations. Chain watchers point to a bullish signal here too. MACD convergence suggests the stock could at least retest its recent highs once it stabilizes, with room to push toward fresh highs after that. Analysts believe the market may still be underestimating just how strong the demand for SanDisk's storage products really is. Finally, SK Hynix, the company that actually invented HBM technology and still controls roughly 60% of the global memory market. SK Hynix has been publicly traded in Korea for years, but recently completed a new listing of shares on a U.S. exchange under the ticker SKHY, raising fresh capital specifically to fund capacity expansion and its push into the U.S. market. That new U.S. listing saw heavy institutional demand, with the offering reportedly oversubscribed. Still, post-listing trading has been volatile, which is worth factoring in if you're deciding when to get in. Some analysts suggest the other two names in this group may currently offer a steadier entry point, while the new U.S. shares find their footing. One quirk worth knowing: the new U.S.-listed shares currently have very limited analyst coverage, only a couple of names tracking it so far. That's normal for such a new listing and expected to broaden over the next few months. The original Korean shares, by contrast, are followed by close to 70 analysts, giving a much clearer picture of how the market values the company overall. For investors wondering how to actually buy in, the new U.S.-listed shares trade like any normal U.S. stock, accessible through a typical brokerage account. Buying the original Korean-listed shares is possible for U.S. investors too, but it's a less straightforward process. So for most retail investors, the U.S. shares are the simpler entry point into this company. Looking ahead, the next major catalyst for all three of these names is the AI sector's second quarter earnings season, now just getting underway. As big tech companies, many of them customers of these memory makers, report results and capital spending plans, that data should offer a clear read on just how strong demand really is heading into the back half of the year. None of this guarantees an immediate bounce, and more short-term volatility is possible. But based on the fundamentals here, capacity constraints stretching years out, surging AI infrastructure spending, and a sector-wide pullback that looks more like profit-taking than a change in the story, this is a space worth watching closely. This video is for education only, not financial advice, so always do your own research. If you found this breakdown useful, hit subscribe for more.